Scaling in and out with basic options strategies. Let's get ready because we're going to talk about many what-if scenarios. This is going to be a video lesson where I go from slide to slide and talk about one option, another option, one environment, another environment, one action in case of this, one action in case of that. And this is going to help to put many things together, many of the things that you have been learning in the prior video lessons. And hopefully it helps you to getting closer to having a trading plan, a process, a method that makes you more systematic and more adapted to the marketplace, to be safer and potentially to capitalize on whatever the market has to offer. Anyway, let's begin. So the idea is to not look at trading like it's a binary thing. It's not all in, all out, which is a classical amateur approach to trading. It's more about scaling exposure, which is much more of a professional approach. Scaling means to progressively deploying capital and accumulating exposure over time or across different price levels to smooth out average entry prices. So we are entering little by little. So ideally we improve our entries either from a probability point of view or from a price point of view, which reduces risk. And then same thing on the way out, we scale out, which is gradually unwinding a position to lock in partial gains, reduce risk, or adjust to changing market conditions while retaining a runner for further upside. That's the idea. So how can we add in, remove out, knowing that there are multiple option strategies that could be employed, buying a call, buying a put, doing a cover call strategy, doing a collar, doing straddles, strangles, all of those various things. So first of all, why would you want to not go all in, all out? Why would you want to adjust exposure progressively? There are three key reasons. Risk mitigation is one of them. Capital efficiency is another one. And also very important and often less discussed, the emotional control. So it brings in confidence to enter a position as we get more evidence that the trade is doing well, and it adds a lot of fear to be fully loaded on a position that is working against us all the way. So again, by scaling in and scaling out, we have more control about risk and capital efficiency as well as our trading emotions. So we're going to have multiple building blocks. We, of course, need to understand what each option strategy is for. So we have our directional amplifiers. That's when we want delta. So how do we get delta? Where if we want positive delta, we buy calls. If we want negative delta, we buy puts. Another possibility, if you want to be long or equivalent to a stock position, is to do your synthetic longs. Another building block would be income and acquisition anchors. So you have the cash secured puts that allows you to get paid while you wait to buy a stock at the price that you want. And if you end up doing that, you get the stock discounted. You also have your cover calls that allow you to get paid to sell your stock at the price you want. And if that happens, you sell it for an enhanced price if you wish. And then we have our volatility and protection wrappers, which could be our collars or our long straddles or long strangles. So let's talk about different possibilities. As I said, we're going to look at many possibilities in today's video lesson. So step one could be that you have a specific understanding of a market opportunity and you decide time to enter. I want to be long. So what you do is that you need positive delta. So what you do is you buy a long call. But in this example, the key is that you buy one, only one, because you are in testing the water mode. You, of course, believe strongly that your trade opportunity makes sense and is in line with your trading plan. If not, you wouldn't trade. But instead of taking full risk from the beginning, one possibility would be to just buy one call to test the waters and see what's happening. Now, let's say the market proves you right and begins moving in. You may now, step two, add more calls to your original call. And that way, by adding units little by little, you are now and benefiting from a more controlled risk, if you wish, as well as, again, you have all those benefits from a trading psychology point of view, where you get more evidence before you add size. Also, if the market goes up, volatility may go down, so the following calls you buy may have less implied volatility built in. Again, so you get a series of benefits. Of course, you also have a downside, which is the market may rally so far up that when you want to buy your following calls on step 2, they are too pricey and you decide not to do it. But you also have the great benefit, and that's the whole point, that after you do step 1, if the market was not to prove you wrong, remember we are testing the waters, if the market was not to prove you wrong, you would get a loss, which would be very small, given the fact that in this trade you wanted to buy 3 calls, but you only bought 1. So the size of the loss would be proportional to 1 instead of to 3. Another possibility, instead of buy with calls, would be to buy using cash secure puts, by using laddering down and laddering out approach. For example, as we can see on the upper left side of the slide, so the stock is trading at a certain level, we want to acquire the stock at 100, so we sell a cash secure put using 100 as the strike, so we sell the 100 put. Now, if the stock comes to us, congratulations, we now got the stock put to us, that's what we wanted. But let's say the stock keeps going down. Again, when we do cash secure puts, it's because we want ownership of the stock genuinely. So that means that you may have a very long-term fundamental reason why you believe that stock at some point will move up, or maybe the stock pays very generous dividends while you own it. And again, you want to own such shares. So what can you do? You can sell another cash secure put at a lower strike price, in this case the 95 put. And again, if the stock keeps falling down, it's acquired to you. And as it keeps going down, you keep doing that. Again, of course, before you start doing and before you start selling the initial put, you had done the math and you knew exactly how much capital you wanted to allocate for the trade. So let's say you wanted to allocate $300, so that allows you to sell up to 3 puts. So you sell 1 put at 100, 1 put at 95, and maybe another one at 90. And then if it keeps falling down, you don't keep selling puts, because then you would basically trading in the very, very opposite direction of the market for way too long. And while you would get a good averaged down entry price, you have no proof or evidence that the stock may want to turn around and move up, which is why you are doing this for, right? So you should also limit, given your capital and allocation percentages and everything else, you should limit the amount of capital devoted to this trade before you get started, and that determines how many puts are you going to be able to use. So let's say you did 2, and now the market turns around and starts moving in the opposite direction. So now that the market is moving up, your shares that were put to you through selling cash secure puts are now performing very nicely. You were paid on the way in. Now you have evidence that is moving in your direction. So now you may start doing cover calls, selling calls against the shares you own to get out. Okay, and that would be a very nice way to be paid on the way in and be paid on the way out, and be adaptable to the marketplace, giving yourself the opportunity to get the stock at a discount, which is the concept of using cash secure puts. But by doing it multiple times using lower strike price points, you are basically helping yourself to enter at the lowest price possible, or the ideal price possible, and then just waiting for that turning point to take place. Another possibility would be you have a portfolio with multiple stocks, and you always have X amount of capital waiting, ready to shoot if an opportunity appears. And in this case, the opportunity would be that the market went way too quiet. Okay, so the market may have a VIX of, let's say, 20, and next thing the VIX dropped to, let's say, 10 or 12. And the market became very quiet, the options became extremely underpriced, and you have this extra capital, they're ready to shoot, and you are like, okay, the fact that the volatility is very quiet may mean that the market will continue moving up because everybody's very calm, or maybe this is just the calm before the storm and the market is going to crash like crazy, but I have no idea what's going to happen. Now I do have a portfolio, so if I could add more to the portfolio if the market goes out, that would be great. But if the market was to go down, I will want to profit on the way down as well, which would probably not only bring in some profitability, which is nice, but also that profitability could serve as a hedge to protect some of the pain I would accumulate with the stocks I am owning and I'm long. So maybe you are thinking this way and you're like, okay, so well, then I'm gonna do my long straddle or my long strangle with X amount of capital, right? So progressively, you layer a long straddle, buying at the money calls and puts, or a long strangle, which that would be out of the money calls or and puts. And you may do it in fractional sizes over several days, leading to an expected volatility expansion, which of course, if it doesn't happen, you will lose the premium paid, of course. But if it does happen, no matter which direction, it would serve you nicely. And then let's say the move started happening, no matter the direction. What you could do is that you could sell the profitable leg. So if the move is up, the call is making money on the straddle or strangle. If the move is down, the put is making money on the straddle or strangle. So you can sell that leg to lock in the primary gain, and then you keep the other option, which has lost so much value already. But instead of closing it for a loss, you just leave it to expire worthless, which would be just a tiny extra loss if that's the case. But you now have the benefit that if the market was to turn around, that option that at some point looked like it was going to expire worthless, next thing you know, it may bring in some profitability while you already got some profitability from the other side, from the initial leg that you already closed for a profit. So this could be another possibility on things that we can do as we scale in and scale out. Depending on market conditions, we should be ready to increase directional exposure, assuming that we have capital available. We should be ready to reduce exposure as well. We should also be ready to adjust volatility gains, right? So what I just mentioned a moment ago was an example of that. So again, you are in a position where you look at your market, very strong uptrend on the S&P 500, and you're like, you know what? I'm gonna add a few more calls or a few more synthetic longs to my positions, or I'm gonna add new stocks to my portfolio, and I wanna do it by buying calls or doing synthetics. That could be the case. And of course, you need capital to do that. So I'm assuming that you had utilized capital that you can use for that. Now, let's say you've been hitting targets and you have been reducing gains, or you may see that the market is giving you some sort of little bit of a threat. So you want to reduce delta, right? So how do we reduce delta? We can reduce delta by either buying negative delta, which is buying puts, or selling positive delta, which is selling calls. So if you sell calls against your stocks, you are doing cover calls. If you buy puts against your stocks, you are also reducing the delta in both cases. Okay, now of course, the idea is to do it in a way that is adapted to volatility. So if the volatility, the implied volatility of the options are very low, you focus on buying puts. If the implied volatility of the options is very high, then you focus on selling cover calls. So you sell expensive options and you buy cheap options. It's all about delta in the end. Delta is the directional exposure your portfolio has. And it's important to understand that while we use the term delta when dealing with options, to be honest, when trading stocks also have delta. We never talk about it because the delta of a stock is 1. 1 share is 1 delta, 100 shares is 100 delta. Whereas an option may have a delta, like a call may have a delta between 0 to 1. So let's say you buy a call with a delta of 0.3. 0.3 times 100 is 30 delta. So a long call may have 30 delta. A stock position, 100 shares of stock, has 100 delta. So we normally don't talk about delta with the stock, just because it's more, if you wish, options terminology. But you could certainly create an equivalency, and it's very healthy to think about your stocks as delta instruments as well. So let's say you have a stock portfolio where you have 100 shares of a stock. That's 100 delta. And then in parallel, you have a call from another stock and another call from another stock. And each of those calls is going to be 50 delta each. So you have 100 delta from the stock plus 50 delta from the calls that represent one of the stocks, and 50 deltas from the calls from the other stock I mentioned. So what would be the total delta exposure at a portfolio level? It would be 200, which is 100 for the stock and 50 plus 50 for the 2 calls that you own. It's important because when you are adapting to market conditions and you add delta or you subtract delta, this not only exposes risk and performance to the options positions you may have, but also to the stocks. It's all the same in the end, and speaking in delta terms, it's very convenient. So now that we know that stocks and options all got delta, so let's talk about the classical strategies we've been discussing. So long stock is 1 delta. Short stock, which is something that we won't do, but just out of curiosity, short stock is -1 delta. A long call is a delta that goes from anywhere between 0 to 1, depending if the option is deep in the money, at the money, out of the money, or deep out of the money. So deep out of the money would be delta of 0, deep in the money would be delta of 1, at the money would be delta of positive 0.5. Long puts is the same thing, but because they are negatively correlated, it doesn't go from 0 to +1, it goes from -1 to +0. Okay? It's the same thing. An option, a put, which is deep in the money, would have a delta of -1. An option, a put, which is deep out of the money, would have a delta of 0. And at the money put, would have a delta of -0.5. And in the case of the cash secure puts, because we sell the put, meaning that we sell the negative. So let's say you sell an at the money put, which is negative 0.5. So you sell the negative 0.5. So sell negative is negate the negative. So that becomes positive 0.5. And you can see on the bottom left, cash secure puts have deltas which are going from 0 to 1, even though we use puts. And it's because we sell the put, we negate the negative, so it's positive. And so in other words, selling puts or buying calls is bullish. It has positive delta. And on the right, shorting stock, buying put or selling call is bearish. It has negative deltas. We can see the cover call strategy on the bottom right, which is sell a call. Calls have positive deltas from 0 to 1. So then I sell the positive. So I negate the positive, that's negative. Okay, so -1 to 0, as you can see on the screen. It's important to understand this because now your portfolio can be made of you own a stock and you did a cover call and then you bought a put for protection and then you bought 2 more calls from another stock. All of them bring in deltas, and when you add them all together, then you get to know the portfolio delta, which allows you to scale in and scale out at a portfolio level beyond scaling in and scaling out at a stock level. So this concept of stocks having deltas and options having deltas allows me now to introduce you to the concept of hard deltas versus soft deltas. So hard deltas is the delta coming from stocks. We call them hard because they don't change. Whereas soft delta is the delta coming from options contracts, and we call them softs because they change. If you recall, gamma changes delta. So as the underlying asset goes up or down, its gamma effect will change its delta. And not only that, as time passes, as volatility changes, all of these will change the extrinsic value of the option, and that will have an impact on how much delta that option provides now that things have changed. Could be interest rates, could be volatility, could be time to expiration, could be the stock movement. Whereas with the hard delta, it's very clear. Stocks is 1-to-1 long, and short is -1-to-1 short, and it never changes, so we call them hard deltas. So you could do this balancing act. Let's say you have a portfolio made of 100 shares and you want to hedge it. So one possibility would be to buy a put and hold it all the way to expiration. And if the stock is below the strike price, the put would be auto-exercised and the one put would sell 100 shares of stock. And since you are long 100 shares and now you are selling 100 shares, then you end up flat. And that one put would protect the 100 shares of stock you own. But notice what I said, if you wait to expiration. That's key. Because the other possibility is that maybe you are buying an option that expires in 30 days, but you only want to be protected for 2 days because there is a risk of some big news to come up in the market, and maybe you want to either protect or you want to scale in, scale out, you want to reduce delta, whichever thing you want to do for whichever reason, you don't want to do it all the way to the expiration. So what could you do? You could now think about delta equivalencies, and let's say you buy 2 at the money puts. Each at the money put will have a delta of 0.5 times 100, that's 50, negative 50. If I buy 2 at the money puts, they will bring in negative 50 delta each, which the negative 50 delta each, that's negative 100, which together with my 100 shares of stock, which is positive 100 hard delta, I would now be delta neutral at a portfolio level by doing that. So now you don't care if the market goes up or down, you don't profit, you don't lose, you basically froze the performance. Now, you may argue that what's the point of freezing performance? You may do it as a temporary hedge. You may do it in a way where you are actually betting on volatility, because if you think about it, you just neutralize direction. But now if everybody gets scared in the marketplace and there is a very big news that makes everybody believe the world is ending, the implied volatility of the options will increase by a lot. And what would happen now is that the 2 puts you purchase are not making extra money on direction because the delta is what it is, but the extrinsic value portion of those puts is growing intensively because implied volatility is growing. So now you are, by closing the whole thing, you would actually close it for a profit, even though your delta was neutralized, but you would be making money on Vega in this case, as volatility has increased. Again, maybe a bit extra complex for the lesson I was planning to deliver here, but just throwing the concept out there for you to think about it, or maybe you watch this video lesson again another day after you had time to practice options trading and you are now able to digest this concept a bit deeper and you can implement it. Now, the color is another way to alleviate a portfolio when it comes to the concept of scaling in and scaling out. Why? Because when you do a color strategy, you keep that directional bias. But at the same time, you do set a hard floor with a protection. If you think about it, is a strategy done when you sell a call and you buy a put with the premium collected from the call, or some of it, you buy a put that end up either free or for a credit or very cheap. So when you do that, think about it from a delta point of view. Selling a call is negative delta and buying a put is negative delta. So let's say you have 100 shares and you bring in 30 negative delta by doing the collar. So now you are left with a position which is net 70 delta instead of 30 delta. So you are reducing exposure by doing the collar, while you still allow for your portfolio to profit in the way up, but you are indeed reducing exposure. So here's an example. Again, there would be millions of examples here that I could construct with slides and look at all the million different possibilities for combinations. But here is another piece of information, or another example that could serve as food for thought and get you thinking and help you construct your trading, your systematic trading process. So let's say day one, you are bullish on a stock and you want to acquire it, but you just want a better entry price. So what you do is that you sell an out of the money cash secure put. That was a 0.2 delta, negative 0.2 delta put. So you sell it, so you get positive 20 delta. And now you are being paid to wait. Now, let's say 14 days later, the stock does drop below your strike. So now your put is obliging you to buy the stock. So shares are put to you. And now you are in a stock position. So your delta that was plus 20 became plus 100. Notice how you are scaling in automatically from 20 to 100. Now you have a base position which you acquired at a discount, and now you can do things with it. Okay, so the amplifier, that could be day 20. Let's say the stock finds support, breaks out of that support, you gain more confidence on the trade making sense, so you decide to buy a call on top of your shares. So you are long 100 shares of hard delta stock, and you buy a call with 50 delta. So you are now net positive 150 delta, 50 from the call, 100 from the stock. So now you are scaling in as you got more evidence. Unfortunately, that time the market was not behaving as expected, and it turned around, and now the market gets choppy and you get concerned. So what you do is that you buy one put to protect the shares, and let's say the put you buy brings in negative 50 delta. So then your long stock plus the long put plus the long call all together brings you back to a net delta of plus 100. So you are scaling back to absorb some perceived risk, which is temporary, while you stay in the trade. You don't have to close the whole thing and start again from zero. You can just stay in the trade and play with those positive and negative deltas to readapt. What about this other example? Again, as I said, many examples, many possibilities. Okay, this may be you. So step one, you are in a synthetic long position. In case you forgot, a synthetic long position is made of buying a call and selling a put. So you buy a call, you sell a put, and that replicates owning stock. Even the time decay is not present any longer, because the decay you suffer on the call, you benefited from it on the put. So it neutralizes itself. So you are basically in a stock position, even though it's synthetically created. Now, let's say that stock rallies intensively. Okay, so you may decide, step two, to close the short put. Why? Because the puts, they gain value when the stock goes down. So if the stock goes up, the puts go down. So you sold the put for, let's say, 2, the stock goes up, and now the put is trading for 10 cents. So you buy to close the put for 10 cents. So out of $2, you made 190. And now you are left with a long call that has no more time decay element. Yes, 10 cents, which is the 10 cents you bought the put back for. So that would be the only downside. This is the amount of money that you left on the table, if you wish. But in exchange for those 10 cents, you are now left with a call that is in the money because the stock went up. So you have real value in the call. And whatever extrinsic value is in the call that will decay, and some extrinsic value will be there and it will become zero on expiration, is really not hurting you, because you already collected all that profit from the put side. So that's another way to scale out, and really it's one of the key reasons why doing it a synthetic long could make sense. Now, it's very important when we do all those manipulations of a portfolio, scaling in, scaling out, all those adjustments, it's to be honest, it's very flexible, it's fantastic. At the same time, we need to be careful. When scaling, we need to have risk management at the top of the priorities at all times. We need to make sure that our position sizes are in line with what's desired from a risk management point of view. So we don't start scaling in without thinking, oh wow, I'm running out of money now, I don't have more money to buy more calls, or I sold too many puts, if the shares are put to me, now I'm going to have a problem. We want to make sure that we pre-plan properly. And obviously looking at size, it's absolutely critical to manage risk. Delta awareness is another component. Remember, delta is being changed by gamma. So as expiration dates approach, gamma becomes very sensitive, and gamma will change delta very fast. If that's happening in your favor, that's fantastic. If that's happening against you, that's problematic. So you need to be on top of your delta. You need to be on top of expiration dates. There are times where, apart from scaling in and scaling out, you should also implement, as we discussed in other video lessons, rolls, where you roll up or you roll out or you roll up and out, and you keep readapting the position. Your delta is truly under control, and you never have a large gamma value changing your delta too fast. Now, the averaging down trap, which is the third box on the right, this has to do with scaling into long calls or puts as they lose value against you mathematically dangerous, because averaging down using cash secure puts makes sense. It needs to be pre-planned, as I said before, but it makes sense because as the market goes down, the put become more expensive because the market is going down and because people get in panic mode, so implied volatility grows. So the puts are becoming expensive because of two reasons. So you keep selling them and you keep getting the stock at a greater discount as you average down. So you are averaging down in a way that is extremely efficient. But if instead of averaging down by selling puts all the time, you were to average down by buying calls as the market goes down, the problem is that as the market goes down, your calls are losing value. That's great. They're cheaper, but people get panicky. So the implied volatility is growing. So your calls are losing value because of delta, but they are gaining value because of the implied volatility. And therefore you end up buying options that are every time more and more loaded with extrinsic value. So let's say you are right, and in the end the stock turns around and moves in your favor. When the stock moves up, typically volatility will go down. So all that inflated extrinsic value that you purchased for those multiple calls on the way down is now shrinking in a massive manner, where you would need to be right on the direction, and you will need the stock to move at the speed of the light on the way up for you to end up making a profit. So averaging down is something delicate, and if you do it with calls that you purchase, it's probably the recipe to get into trouble. If you were to do it with cash secure puts, it certainly could make sense as long as you pre-plan for it properly. So we added modularity today, right? So we have our calls, our puts, our cash secure puts, we have our cover calls. All of these are, you may want to think about them like dials, so we can calibrate our exposure over time. We adjust progressively, so we scale in, we scale out, so that way we eliminate that emotional trap of being all in, all out, and it goes in your favor too soon and you are greedy now, or it goes against you too fast and now you are paralyzed by fear. So we are entering slowly in whichever direction that is, which increases our control, our self-control, our trading psychology and management as well. Dynamic delta, right? So we master the difference between hard and soft delta, and we could go all the way to neutralizing delta if needed. And of course, on top of everything I said today, you have your risk management rules, where we need to keep position size and any other element that impacts risk, allocation, percentage of allocation in your portfolio, correlated assets. All of those things need to be totally under control before we begin with all those calibrations and the tweaking of the dials.